Morning, everybody. I'm Nick Brummer, Director at Investonline. I'm with my fellow director, Stuart, Dyer. And today we're talking everything about living annuities. We're based out of Cape Town, Newlands. We work in a team of 15. We're financial planners and investment advisors. And we've been doing these webinars quite regularly, which have been very well received. Today, living annuities, most retired folks have got one. So I think it's important to go through the nitty-gritty. But we're going to go through this presentation. It should be around about 40 minutes or 45. And we've got some of your questions that we're going to handle towards the end. So let's look at the agenda for today. Right, so the 5 main points is going through the product rules, and that's definition, income rules, and funding routes, investment options, fund choice, offshore limits and transfers, lasting the distance, how long and does your living annuity last, and what should you be drawing, really important, death and estate planning, beneficiaries, and what options there are, and then tax and how one really incorporates the most tax efficient way into your living annuity and your financial plan. So we're going to kick off. Stuart, you're going to start off with section 1.
Hi, morning everybody. Thanks as always for joining in today's topic. As Nick's mentioned, we're going to be covering living annuities, and I know this is a topic that's one that's got a lot of interest. As Nick has said, a lot of people may have a living annuity as part of their portfolio, either as a really major part of their investment assets in retirement, or they potentially just have a portion of their capital in a living annuity. It's important to see how it fits in and how it really works. So just to start with, in section 1, I'm going to go through just a bit of the definitions around living annuities and what the product rules are. Simply, a living annuity is a post-retirement investment vehicle. So when you retire from employment, or if you are over the age of 55 and you've got a retirement investment like a retirement annuity, then you can then convert either your employer fund or your retirement annuity into a living annuity, and that living annuity stays invested. The capital continues to be invested, and you merely draw an income from the investment portfolio. The income is bound by living annuity rules. Currently, the range is you're allowed to draw between 2.5% and 17.5% of your capital value as an income in that 12-month period. So how that works is you can either say if you want the income as a once-off annual lump sum, or you could do a quarterly income, or you could elect, as most people do, to get a monthly income, like a salary. And that range of what you're allowed to withdraw changes year by year, depending on the value of your investment. And the capital is locked in. So once you've now retired from your fund, whether that's an employer fund, a retirement annuity, or a combination of several funds, and you've moved that into a living annuity, you can't then go and take a lump sum withdrawal or undo that at a later stage. It's similar to, you really locking your money into a post-retirement vehicle, and you need to be quite sure that you intend to do that when making that decision. The only time you can actually withdraw a living annuity is if it reaches a capital value of 150,000 Rand and below, at which point you are allowed to withdraw the full living annuity as a cash lump sum. So we've gone through the income rules, and I've explained the 2.5% to 17.5%. We'll go through what that means in what's practical from a drawdown perspective in a few sections' time. And as I've mentioned, that income is recalculated annually. So often you may have a percentage in mind that you intend to draw, but as your investment performance does well in certain years, perhaps is a little bit slower in other years, you may have to recalibrate how much you're withdrawing and recalculate. And then living annuity income is fully taxable. We're going to go into more detail around the tax treatment. but it is seen as a source of taxable income, exactly the same as a salary. The living annuity provider almost gets viewed as the employer. So you get your normal tax certificate from the living annuity provider, the same as you would get in an employment environment, and that tax is withheld as pay as you earn by SARS. So you get a net income in your pocket, just like you would if you had an employment income or salary. So how do you go ahead and fund a living annuity and invest in one? So the most common route is to invest through a retirement fund that you've saved into for some time. So you've got either a pension fund or a provident fund at work, a preservation fund that you may have from past employment, private retirement annuities that you've opted to take out, or a combination of all of these funds, and you can retire from those funds from age 55 or when you cease employment, and that capital then moves into a new living annuity investment. Or route 2, which we are seeing more commonly these days, is investors actually choosing to elect to take discretionary cash surplus money that they have and investing it into a living annuity. What you have to do is you have to put the money into an RA first, and then you immediately retire that RA into a living annuity. So it can take a week or two. It's just a bit of an admin process. And then you've really taken discretionary money that wasn't from a long-term retirement fund, and you've put it into the living annuity structure. We'll cover in the last section why someone would do that and where it could potentially fit in as a tax and estate benefit. And then we're not going to talk too much income tax in this webinar. We do have other webinars where we cover income tax in a lot more detail, including next month's webinar. But how it works, and you may be aware, is you can claim your contributions to a retirement fund as an income tax deduction against your tax in that year, up to a certain threshold. That threshold is 27.5% of your annual income, to a maximum of 430,000 Rand a year is the new maximum that they introduced this year. And if you contribute more than that, I think a lot of people think that that's the maximum they can put in. Absolutely, you can contribute as much as you like to retirement funds. So there is no maximum of what you can put in. If you contribute more than what you're able to deduct from your tax, that is then defined as an excess contribution. Now, excess contributions have their own treatment, which we'll cover towards the end of the presentation. I just wanted to flag it here. So, Nick, I think I'm going to ask you just to chip in on the investment options. If you just go through this section for us, please.
All right, thanks, Stuart. So, investment options. Where's the money invested and what am I allowed to hold? Let's go through those options between pre-retirement and a living annuity. So pre-retirement, let's just think simplistically just as your RA. You're governed by Regulation 28, where living annuity you're not. Offshore maximum pre-retirement is 45% offshore. Living annuity, you can put 100% offshore. Then also the same restriction again with pre-retirement of 75%, and some single asset classes are capped, as opposed to living annuity you can see is very flexible. So it's to have some restrictions in place as you're saving up for retirement, and then a lot more flexibility once you retire and into a living annuity. I do want to stress that there are some times where some of the smaller institutions are limited by amount of money that they can actually take offshore. So there are some living annuities where you can't take 100% offshore because of some institutional restriction, but mostly with the large institutions, because they have much bigger balance sheets, they have much more capacity to take money offshore, and there are no restrictions in your living annuity percentage you take off. Right, so where can you invest this money? So basically it's a very broad ranged equity funds, both local and offshore, multi-asset funds, so you can have your normal balance funds or stable funds that you could invest in. Then you can also do direct. You can invest directly into shares, directly into ETFs. And the nice thing about it is that also switching wise, you can make all different changes when one feels necessary. You want to change a particular strategy, there's no capital gains tax. So it's capital gains tax free, and it makes switching a lot easier. Transferring a living annuity. So you can transfer your living annuity between different providers, and there's absolutely no capital, there's no tax implication. The capital is just moved from one provider to another. Then also in terms of your income continues as normal. It's not changed at all. Then you will effectively at your next anniversary, you would be able to change your percentage drawdown as well. And it's not a taxable event. So there is a lot of flexibility in transferring a living annuity between different providers. Right, Stuart, take us through last in the distance. I think this is a really important section regarding how long your money can last.
Good, thanks, Nick. So here what we're going to go through is really around drawing a sustainable income. So we've done quite a few nice scenarios. Just to start with, this is a table we've put together. So often with the living annuity is a strange investment vehicle. And I think it's really important to model it correctly, in that drawing your capital you have in a living annuity to zero is a very, very difficult thing to do, because you're capped at the 17.5% maximum that you're allowed to withdraw in any given year. Even if you had the intention of drawing it down as fast as possible, you're basically taking out, it's about 1/6 of your money, and then the whole time your capital is getting less and less, but you're still restricted to that 17.5%. So with the living annuity, it's not as easy as doing a basic financial calculator and saying, I'm going to see how long my money will last. You really need to see how long can you keep drawing a certain level of income before that income hits the 17.5% maximum threshold. Because at that stage, naturally what happens is you can still have invested capital, but your income is going to start to reduce over time. And the reason it's going to start to reduce over time is you can't ordinarily earn a return of 17.5% year after year. So you're drawing more than you're earning. And at that point, your capital starts to slowly deplete. So it doesn't mean you run out of capital overnight. In fact, it can take a long time, as long as 10 years plus for your capital to run out once you hit that point. But for most people, you don't want your income to start reducing unless you've got other income and you've prepared for it. So in this table, what we've said is if you are retiring, how many years would it take at certain percentages that you're withdrawing for your money to reach that 17.5% limit, and therefore your capital starts to reduce. So at age 35, if you're drawing 4% of your capital per year, you're getting about 3,360 Rand per month. In that scenario, it would take 35 years for your capital to hit the 17.5%. And you could just work your way down the table. 30 years, it's 4.3%, 25 years, 20 years, etc. If you're getting to 7.6% as your drawdown, then it's going to take you about 10 years for your capital to reach that 17.5% cap. What we're assuming here is that the initial drawdown merely equates to your starting Rand value you're going to draw. And every year that Rand value is going to go up by an assumed inflation of 6%. So it's not that you're just sticking to a 7.6% drawdown. We're assuming that your income is going to go up to have to keep up with inflation. And that's why your capital or your income as a percentage continuously grows over your retirement. And we've got some pictures we'll show, some projections around this illustrated. So to start with, I think a common drawdown is at least a starting drawdown of 4.5%. You can see what happens with your capital. At age 65, your capital actually continues to grow for about 20 years, because there you're drawing 4.5%. In this scenario, you're earning 9%. So you outgrowing your capital for a fair amount of time. And then as that 4.5% as a starting drawdown starts to increase, because you're increasing your income by inflation every year, your 4.5% slowly goes up over 20 years. And now we look at where do you actually hit that liquidity constraint. That would only be around age 93. So that's where you get this, narrative in the financial media that if you want your money to last 30 years, you must start with 4%. And really where that comes from, it doesn't mean your capital runs to zero at the end of the 30 years. It just means that that is the point at which stage your income could come under some pressure. If we had to do the same scenario at with 6%, so now you retire at the age of 65, and instead of starting with 4.5%, you start with 6%. You can see how the capital starts to fall down more meaningfully. The growth in that first 20 years is a lot more subdued. The capital almost stays at more of a plateau for the first 15 years, and then it starts to come down. And that liquidity constraint, which again doesn't mean you don't have capital, it just means you can't increase your income from that point forward, that hits at age 81. So in that case, it's 16 years into retirement, your income potentially becomes under a bit of pressure. And now if we had to do a higher one at 7.5%, as you would expect, the capital comes down earlier, and that liquidity constraint is actually hit as quickly as 11 years after retirement. So your capital is still there. It looks like you potentially still have around 7 of your 10 million rand at age 76, but at that point your income is going to start to reduce, which is, potentially a problem if that's your main source of income to fund your lifestyle and your expenses. So in this section, we're just going to go through the death and estate implications, and then I'll talk a bit more about Section 10C, which refers to the excess contributions. So just simply, a living annuity is an investment product that sits outside of your estate. You are allowed to have a beneficiary nomination. And unlike a pre-retirement fund, the beneficiary nomination is binding. So in a pre-retirement fund, which is a retirement annuity, pension fund, provident fund, preservation fund, all of those funds have trustee discretion. So if you pass away, the trustees need to go and determine who your dependents are, not your beneficiaries, your dependents. And they decide what a fair distribution is of your fund. So that takes up to 12 months. And you would see in the media quite a few articles where unintended persons or people who weren't nominated as beneficiaries got some portion of the retirement funds because the trustees use their discretion on it. So with the living annuity, you don't have any of that risk. Whoever you fill in on your product as the beneficiary, they will be the ones that inherit the capital. And your will doesn't affect the living annuity. If you remember, anything with the beneficiary nomination, it supersedes a will. The will only handles what is left over after all your products have been distributed per product rules. So a living annuity, I know we also talk a lot about wrappers and offshore wrappers. Any sort of investment with a beneficiary nomination will be handled at product level and not by your executor. And quite a good estate planning tool these days is actually to nominate a trust, if you have one, as a beneficiary of your living annuity. I know this can be particularly useful if you do have trusts for minor beneficiaries or special trusts for family members, where you feel that the beneficiaries themselves aren't capable of handling that capital or making decisions around those amounts of money. Then that's where a trust can have real practical use in being nominated as a beneficiary. So now after you pass away, the beneficiary gets informed that they are a beneficiary of the fund, and each beneficiary gets to elect what they want to do with their portion of the capital. So if someone takes over your whole fund, the full amount of capital falls to them, and if you do half or a third or whatever it may be, they're going to get to elect what happens with their percentage of the rand value. So the first choice they get is to continue the annuity. What happens there is the annuity gets sold, the capital gets split, and they would then essentially have a brand new annuity in their own name where they would be the investor. And they can say how much they want to draw as an income. So in that case, there's no estate implications because there's no estate duty or anything that applies. The income that they draw will be subject to income tax in their own names because now it will be taxable income sourced by their own annuities. Other option is that they can take the cash. So if they don't want to have an annuity, potentially if they live overseas or if they really want to take the capital, they can withdraw the full amount as a tax lump sum. That is taxed as per the retirement tax tables. So the same tax table where you see the 550,000 tax-free all the way up to 36%, that tax table gets applied. And the tax is not calculated on the recipient's tax situation, meaning the beneficiary. The tax is calculated using the deceased situation. So if that individual who's passed away has taken already 2 million rand in lump sums in his lifetime, that tax 2 million rand will apply to the tax table for this transaction. So a living annuity is not a good estate planning tool for the person to take as cash. As we know, estate duty is 20% up to 25% in South Africa. So if you do intend to pass money to potentially children who are outside the country and they intend to take it as cash, 36% is what they can expect to pay in tax, which is quite heavy. And they can also do a combination, which is nice. I know, if a child potentially wants to take a certain amount of money for some upfront needs, but then annuitize the rest, they are able to do that. Now we just cover a bit on tax in section 10C. So 10C is everything to do with excess contributions, really important part of the Income Tax Act. So your income tax is taxed as normal income, as I mentioned a bit earlier. The pay as you earn is withheld at source. So the institution who holds the investment, the platform that holds it on your behalf, they withhold the tax and they pay the tax to SARS, just like an employer would. And as Nick mentioned earlier, when it came to switching, there's no tax inside the product. So the product itself is tax exempt as an investment instrument. So any interest income, capital gains earned within the funds or shares, ETFs, whatever it may be within the product is tax exempt. So what's nice as a vehicle, let's say you've got a living annuity that makes a 10% annual return and you only draw 2.5%, you only pay tax on 2.5% you draw, not the 10%, which is very different from interest income held in your own hands. If you earn a 10% interest rate at the bank and you do it in your own hands outside of any product, you're going to pay tax on the full 10%. So that's where a living annuity is a good vehicle in terms of growth, particularly when it comes to around interest income. It is tax friendly. So excess contributions, I mentioned earlier, the new limit now, 430,000 Rand as a maximum that you can withdraw in a tax year. That could obviously be lower depending on how much you earn. If you don't use that deduction in the tax year, let's say you made an excess contribution in this year and you kept working, all of your excess contributions carry over to the following year. And those deductions actually are tax exempt. So what SARS is saying is because you haven't claimed a tax deduction on them, those excess contributions are exempt from tax in other forms. And then what happens is often if you've been accidentally or purposefully contributing more than you can able to deduct, when you get to retirement and now you're retiring from your employment or you're retiring from your fund, and you actually have a pool of excess contributions, you now get to choose what you do with them. And you can either draw it as a cash lump sum, which at that point the lump sum is tax-free to that portion, or if you roll that portion over into a living annuity, which is what we're covering today, you can draw tax-free income. And how it works practically is you don't actually get the income tax-free. The institution still taxes you on the income, but that income is then seen as exempt. So the pay-as-you-earn is still withheld by the institution, but when you go and do your tax assessment at the end of the tax year, the exemption will pull through automatically to your tax return if everything's been captured correctly, and SARS will repay you the tax that it incorrectly withheld. So what that really means is you retire, you're drawing an income from your pension, which is your living annuity. You know that the excess contributions exist. You can try and calculate year on year how long potentially your excess contributions will last for. You're being taxed as per normal, and SARS will then refund you those, let's say, incorrect tax or excess tax that it drew for the excess contributions that you had rolled over into your living annuity. So to know it's a little bit complex, so we'll go through it in some examples. So this is a case study we've drawn up. So in the case study, we've got investor A, who's at the age of 65. He now is going to contribute a lump sum into a living annuity. He's going to contribute 10 million Rand. So he's doing this as part of a tax and estate planning exercise. He's starting with an immediate drawdown of 6%, which is 50,000 Rand a month. And he plans to escalate that by 6% each year. We've got the same investment return assumption of 9%. And that pool of what he's contributed as excess is immediately 10 million Rand because he hasn't claimed any of it as a tax deduction as at yet. So now we roll that 10 million Rand into a living annuity, and let's see what that looks like in a projection form over the course of his retirement. As we can see here, we've got the 10 million Rand that continues to grow for some time. And what I've done is we've shaded it in two separate areas. You've got the purple area, the lavender area, that is the excess contributions portion. And that portion decreases as he withdraws from the fund. So as he uses those excess contributions as tax-exempt income, his excess contributions pool falls. And in this case, it takes around 10 or 11 years or so for those excess contributions to be depleted. And the rest of the capital that grows becomes exposed to tax over time. And what we see here is that's at age 76, so 11 years later. And we can see the green line at the bottom is his net income. So this is assuming the income he's getting in each year after tax. So as we've mentioned, in the first 11 years, he's going to get the tax refunded to him. And then at that point, when the excess contributions are exhausted, the full income becomes taxable. So in that case, he's had a really great 11 years. He's enjoyed tax-free growth and tax-exempt income. But now, this is the downside of Section 10C, is once you've exhausted those excess contributions, all of the capital that's left over, that was previously 10 million of after-tax discretionary money, you've enjoyed a tax-free time, but now you're going to pay full income tax from there, thereafter. So this is where there are the pros and cons about using this as a strategy, is there will be then a time when you've now subjected after-tax money to full income tax going forward, and that income tax would be at your marginal tax rate. So just to summarize what we've just looked at is that he would have paid zero net tax on the living annuity for 11 years. In this case, he actually would have been refunded around 2.6 million Rand in taxation. But then in year one, after the excess contributions were exhausted, he suddenly would have had a tax bill of 360,000 Rand. So if we look at age 76, his net income in his pocket would have been over 1.1 million Rand. The following year, it would have been closer to around 850,000 Rand. And that's just the effect of that tax exemption having come to an end. And now, just to do one slide, we've covered this as a big topic in other webinars, and I think it is a really pertinent area to be aware of if you are considering using the Section 10C excess contributions as a tax tool for yourself. Is what are the estate implications of that Section 10C strategy that you're following? And in I think the big thing to be aware of is that the exemption falls away with the first investor. So if you invest 10 million Rand into the annuity and you pass away with, let's say, in a year, now the spouse can carry on with that living annuity, but the tax-free or the tax-exempt income that sat in those excess contributions doesn't roll over to the surviving spouse. It doesn't have to be a spouse. It could be any beneficiary. So that person now inherits the money, and that money becomes fully taxable. So they are able to, as per earlier in the presentation, decide to take it as a lump sum if they want, and that would have its own tax implications. But assuming that they did intend to keep the annuity, that tax-exempt income would fall away as a benefit, which I think is really important to be aware of if you are using this as an estate planning tool. So just my final slide, and then we'll head over to some Q&As, is so what are the drawbacks of doing the excess contributions as a purposeful strategy? Is that the excess contributions aren't inheritable for tax exemption. The income will eventually cap out. So you're taking flexible cash, you're putting it into a product that is restricted, as Nick mentioned earlier, and at some point that 17.5% is going to be hit unless you're just drawing a minimum income throughout. Your capital's locked in, so you're no longer discretionary. You've moved your money into a compulsory environment, and you don't get ad hoc lump sum withdrawals as an option. And there can still be a state duty on the cash if the spouse or surviving beneficiary decides to take the excess contributions back as a cash lump sum. It still stays in your estate for state duty. So you don't get away from a state duty if the beneficiary decides to withdraw the excess contributions and doesn't keep it going in the annuity. So you can't win both ways. You don't get it estate duty free and income free. You're going to get one or the other.
Good, thanks, Stuart. Now, that does get a bit technical, and obviously we're very happy to go through that with you at another stage. So we've got some questions that have been submitted, and thank you for submitting them. We can go through them. We've selected 8, and here's the first one. So should one live off living annuity first or access other assets first? So this is really important. Where do I draw my money first from? And it's quite amazing how, well, not amazing, but how people actually get this wrong in terms of drawing from other areas versus their living annuity. So Stuart, give us an answer of what you think we should do here.
Yeah, so this is a really good question, which is why we selected it first here. We actually had this question posed in quite a few different ways by a number of registrants at the webinar. The short answer is you have to do a liquidity model or calculation for your own plan. So our advice or guidance would be very different from between investor A to investor B to investor C. So in short, everyone's got their own combination of how much they're going to spend and where they're going to draw their money from. If your living annuity is a really meaningful part of your investment assets when you retire, like it is for many people, I certainly normally don't encourage putting off using that. So just some round figure example, you have someone who retires with 10 million Rand, but they've got 1 million Rand as severance benefit in cash that they've received. Often you may hear someone say, well, I don't need income from my pension. I'm going to let it grow for another year, and I'm going to live off my cash in the meantime. And often I think that can be short-sighted because that cash can become really powerful as having liquid capital later in your retirement for other things. And we can go through, we've talked about capital goals in our other webinars, replacing your vehicle, unexpected medical expenditure, family assistance, whatever it may be. So in that scenario where your living annuity is a large portion of your wealth, I think that we have to look at it for you. In the reverse scenario where potentially your retirement annuities are just a smaller portion of your wealth and you've got a lot of discretionary capital or business assets, then you have to then think about, well, at what point would you use the retirement funds? I know a big reason people do choose to retire from their retirement funds is what Nick presented on earlier, is getting it out of Regulation 28 restrictions, and just even if you're drawing the 2.5%, getting the money into an environment where you could take on more risk or have more money offshore potentially. So I think those are the base 2 or 3 options. I think often what the answer can be is just a balance. Use both forms of capital. If you are someone that's retiring with retirement money as well as discretionary money, I think using both forms of capital and having a plan to do so is often the right balance that can tick all the boxes across tax, liquidity, and longevity.
Yeah, thanks, you. I'm just going to chip in there again, and just in terms of repeating that, the balance is really critical. And especially also from a tax perspective, is balancing different asset allocations between a different product, i.e. a living annuity and a discretionary fund. So I certainly believe one should spend some more time on trying to get that balance right. Right, question 2. Okay, sequence of returns, a bad year. So this is really about if one has a bad year in terms of investments, where the market, say, dips 10% or maybe even as much as, say, 20% just before your next anniversary. Now, you're forced to, are you going to increase your drawdown for the next year because your funds are lower, or are you going to leave them the same? It can be quite a difficult one. Stuart, what do you think one should do?
Yeah, it's not easy. So in terms of this situation, is often you want to see your investment growing year on year when you retire, and that gives you confidence to then increase your income along with that. And then there can be situations, particularly when markets have done very well for a long period, where you go through 1 or 2 years, either your performance is flat, or as Nick mentioned, if your income renewal comes up right after a poorer period where your capital may be down, then what do you do about that? I think often it all depends on what you can afford to do. So there's no one answer, I think, that is springing to mind here. I think if you can afford to keep your rand value of your income flat for a year or two when performance is going through a poorer period, then I think that's definitely an advisable thing to do. Is to, every rand you can keep invested, particularly when the capital has come down slightly, it just means it will take a less amount of time for your capital to recover back to where it was. So what you don't want to do is draw meaningfully from a portfolio where the markets have come down. So if your portfolio is down 5%, when the markets are down 20%, you down 5%, and now you're drawing 7, 8, 9% from the investment on top of the 5% that the portfolio is down, then you get into a bit of a situation where you're drawing a hole, you're digging a hole for yourself that's hard to come out of. So I think if you can try and keep that income flat, then that will just be better for you.
Right. Thanks, Stuart. That is a tough one. Right, so if I take out 17.5% as an annuity from capital, from a value of 20 million, how long before this capital is depleted? I know we've modeled this before. Stuart, what's the answer?
It's quite an interesting one. I actually had to go look at it again from scratch. It actually doesn't matter how much money it is, because either way, it's going to take a certain amount of time for that 17.5% to eventually pull down to a certain value. So the value we're looking for is 150,000 Rand. Once you can get under that 150,000 Rand, then you can draw out the remaining balance. And actually it takes 43 years, give or take. We ran a few different models. It was anywhere around 42 to 45 years. 43 years was the consensus. So quite interesting that if you want to try to draw down your annuity as fast as possible, it's not something that's easy to do quickly.
All right, next one. Thanks. How to structure a living annuity portfolio. So ideal number of funds, a bucket strategy, index funds only, or active versus passive, annual pay-as-you-go, checking DIY. So I'll take this one. So I think ideal, first of all, to work out what investment strategy is best suited for you. In other words, is it moderate, moderately aggressive, moderately conservative, very conservative? And that all really depends on a case-by-case basis. And once you work out and find out the right investment strategy for you, let's assume a moderately conservative investment strategy, which is probably the most common for retired folks. Then we're going to put that into the right asset allocation, and that asset allocation largely would comprise approximately 40 to 50% in equities, then a portion in bonds, a portion in some property and cash, and then obviously also a portion offshore. So for a moderately conservative investment strategy, generally probably around about between 20 and 30% offshore. And then to put that then into a portfolio, and we subscribe to unit trusts. We believe that's the best place. And a unit trust can include active unit trusts and passive unit trusts. So we believe that both of them have a place in a portfolio. Passive, certainly from a fee perspective, and as active, we have active funds for particular environments where we believe that they can essentially give you a better return over a period of time. So in short, to have a mix, a combination of active passive unit trusts, and generally into between probably 4 and 5 different unit trusts. Right, question number 5. If I convert my RA to a living annuity and draw a monthly income, can I continue with contributions as a tax write-off? Stuart?
Yeah, so you can definitely do that. So often what happens, once you've retired from an RA, you can't then contribute to that same RA. That RA becomes, it's ended. So what individuals do is you can start RAs quite freely. And some individuals will even start a new RA every year with a small lump sum that they work out as equal to their tax deduction. And then you can immediately retire that RA back into your living annuity if you wanted to. Or you could just keep a separate RA that you start in retirement and that you top up every year, and you just let the RA keep growing on the side. So that is something you can do, and there are merits to it. I know I've looked into it. Is it worth it or not? I mean, if you keep being able to reduce your taxable income by using the tax deductions, particularly if you are in the higher tax brackets, it does work as a tax planning tool.
Okay, good, thanks. Right, the hybrid models. Can we discuss a life annuity and switching between a life and living annuity? Stuart, what do you feel about this?
Yeah, so the hybrid model, what that is putting some of your money in retirement and a life annuity. So life annuity is your guaranteed annuity. We haven't covered life annuity versus living annuity in this webinar. We've done it in quite a few of our other topics. And putting some of your money in a living annuity. So there are different views out there about which is best, life annuity, living annuity, or hybrid. I think there are situations where hybrid can work. The thinking is to have portion of your money in a life annuity that pays you a guaranteed income that would cover your basic expenses. You could think of that as your debit orders, etc. And then your living annuity would be the investment portion that you would keep to draw an income from that would be more of a variable income. In modeling it ourselves, there doesn't seem to be too big a case for hybrid over living annuity, because living annuity often does give you the flexibility of keeping all your capital invested while having full variability on all of your capital versus only some of your capital. But there are cases, particularly if individuals are invested in a government fund where the rates you're getting from your guaranteed annuity is abnormally high, where that could be beneficial. And just to remind the audience that you can't go from a life annuity back. So you can't switch between life annuity, living annuity. Even these providers that sell a hybrid annuity as a finished product, the portion that they put into the guaranteed annuity, that portion is there for the rest of your life. You can't go and switch that back into the market. So I know we see that life annuity is almost a fear buy, when people feel fearful of the country and inflation in the country, this was a lot more common 3 or 4 years ago, then they want to lock in their income. Our worry, and where we flag to potential investors, is the big thing you have to do is protect your escalation in your income. Locking in a guaranteed income that seems favorable for life, but picking a fixed escalation such as 5%, or potentially, some people even pick a level income, which means the income will never go up. That just means there's no ways you're going to keep up with the buying power of inflation over time. So if you are going to use a life annuity as a portion of your plan, you have to make sure you model it correctly, that you're going to increase your income by inflation. And in most of our models, a living annuity looks like it'll do the job fine for most individuals.
Yeah, thanks. Just one thing there also on the life annuity is just be really cautious before you make that decision, as it's a once-off. And generally, it ends up making a lot more sense going into a life annuity later on in life. When I'd say later, maybe in 70, 75 years plus. I think that's when the conversation becomes a lot more meaningful. Right, question 7. I pay too much tax on my living annuity. How should I manage this? And if we add in medical aid, that's 35% to 40%. It's just gone. How do we manage this tax?
Oh, interesting one. Obviously, I don't know the situation, so it's difficult to advise on how to draw tax. So the big thing with a living annuity is it's full taxable income. Often, if you are someone who's put the bulk of your savings into pension money over time, and you get to retirement, so you've enjoyed the tax deductions all along the way. Now you get to retirement, you potentially have less flexibility on your tax planning in retirement if you don't have other assets to combine your income with. So to say how to manage it, it really depends on what the situation is. I think a basic one is, if you do have other investment assets, is to split your income between the living annuity. And I know Nick mentioned we use unit trust funds, we use different local and offshore wrappers. So what we call the 3 pillars, portion being your retirement money, other portion your discretionary money, and your other portion being your direct offshore money, is getting those 3 pillars correct. And for those who aren't yet retired, even if you're towards the end of your working career, you could do a lot of work on this before you retire, and trying to see what you can juggle between your 3 pillars to make sure you can have a lot more tax efficient income when you get to retirement. I know certainly myself and my colleagues and a lot of more informed investors younger these days are not just throwing all their money into pension funds and retirement annuities, because you do get tax deductions up front, but we do know that then you pay tax down the line. So you're really just deferring tax. So I think to have more of a balance where you use your retirement funds as part of your savings for retirement, and then use other vehicles like an offshore wrapper, a tax-free investment account, to make sure you've got a good mix of assets when you get to retirement.
All right, thanks, Stuart. Okay, last question. Is it possible to have more than one living annuity that could be bequeathed to different beneficiaries?
Yes, certainly you can. So within a living annuity product, most products give you primary beneficiaries. So you can say one or more than one person who would take the proceeds of the product when you pass away. And then you also have secondary beneficiaries. What that means, if you've nominated one person as the primary, and when you pass away, that person's passed away at the same time or prior to you, then the secondary beneficiaries would kick in. So it's almost like a will where you've got your different levels of bequest, or let's just call it wishes in simple terms. And you can do that within one living annuity. Otherwise, if you've got many living annuities, you could have that however you like. So investment products are very powerful in getting beneficiary nominations right. And I know we've covered this in other webinars, and it's something to be aware of. And I think a lot of people sit and spend a lot of attention to their estate planning when they're doing their will. And depending on how the investments are structured, they will not only handle a small portion of their wealth. You've got to look at your tax-free investments. You've got to look at your living annuities, your retirement funds, if you've got any local endowments, your offshore wrappers, and you've got to check your beneficiary nominations across all of them. Because that is, at product level, that is going to determine who gets your money in all these different situations. And that's what we do for people. And we obviously help with the calculation of estate duty and all those things. So, yeah, living annuity can be bequeathed to different beneficiaries.
Right, thanks, Stuart. Again, we've gone through a lot there. Just really want to recap our services, and please get in touch. We do financial planning. It's often the most important part to really start to really get an overall feel in terms of how we're really going to align your goals and for your family as well. Then also the investment management part fits in with that, and we do independent oversight of your risks and fees. I think that independence is really important. The direct offshore portion as well. Stuart was talking earlier on about our 3 buckets that we use. Direct offshore investing is a critical part of the overall investment portfolio and investment strategy. And that also then fits in with the tax structuring. So all of that goes hand in hand, and with that as well, there's also estate planning that's part of that. So let us have a look and help you. I think getting all of these all aligned can certainly give you some really good visibility into the future in terms of how much you can spend and what kind of lifestyle you really can lead by having all your investments and your financial plan properly aligned and including your estate plan. All right, everybody, thank you very much. You'll be able to see a copy of this webinar on our website. Please go to our website, obviously investonline.co.za, and you'll also be seeing quite a few of our other webinars as well. And if you need any help, please get in touch. You can just email us at Investonline, Nick at Investonline, or Stuart at Investonline, or as we have the info at Investonline. Thank you and goodbye.